Stocks like AmerisourceBergen Corp are value investors' dream stocks if they can buy them at an attractive valuation. The reason they're a dream stock is you can see going back to 2003 that this company has generated earnings growth very consistently year after year after year at a very high above average rate of 13.36%. Likewise, CVS Health is also a value investor's dream stock that produces consistent earnings year after year after year. Once again, at double-digit rates, 11.56%. Watch this video to see how the stock price has reacted to these great results that both of these businesses have achieved. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I've got a very interesting video for you here. It's one that I've done this a couple of times before. But one of my, monikers here is, Mr. Valuation. Well, I'm obviously, as Mr. Valuation, a believer in value investing. But as I produce videos, especially new videos that were just produced, you get a lot of people, in the comment stream, especially if the stock price drops on the stock, and they'll say, well, this wasn't a good pick. The stock price dropped. It's down 8% since you did your video, 17 minutes ago or 2 weeks ago or a month ago, in other words, over the short run. And so what I want to do with this video is I want to try to give you some evidence or proof, if you will, of not only how value investing works, but why value investing works. And it all started with years ago, I did a video on ABC or AmerisourceBergen. I said, invest in AmerisourceBergen for its growth and valuation in May of 2019. But before that, and I think the title of this video is important because I called Better Business Buyer. Check out AmerisourceBergen. That was July 26, 2017. And after I did these videos, that also led to some subscribers to my channel saying that I needed to look at Walgreens and McKesson and Cardinal Health and some other healthcare companies that also had pretty good track records. So I did follow-up articles, but in the follow-up article, initially in January of 2018, I covered CVS as well as Walgreens. I also covered CVS again on May 29th, 2019, and I covered CVS again, where I actually, I'm going to say, recommended the stock on October 11th, 2019. And then I also did a follow-up called the Fast Fundamental Analysis on November 3rd, 2021. So what I've done with each of these companies here is that I have produced videos either recommending investing or, and this is important, alerting viewers and subscribers to the channel that these companies were coming into value, not necessarily meaning buy them today, but they were coming into value. So what I've done, first of all, let's look at what's happened to the price of AmerisourceBergen over this time frame where they've produced such excellent operating results. Number one, when I put weekly closing stock prices, you can see, as I have shown you many videos and many times, how the stock price tends to go where the company's earnings go or where their operating results go. There are times when the companies get overvalued, like when the price is above these orange and blue line that you see here. In this case, they're almost, superimposed, very similar numbers. The stocks also get undervalued from time to time. And, here it was overvalued in 2015. And then we went through this period where I started recommending the stock right around in here somewhere. And then it went through a period of being undervalued and the stock price was down. And now today the stock is trading just, a tad above what I would call fair value. So that's what AmerisourceBergen has looked like. Likewise, if you go to CVS Health Corporation, which I had did a video on 4 times in the past, as I showed you, if you put price on the graph, you again see the same type of action. Ultimately, the price follows earnings, that's for sure. But there are times when the stock gets overvalued and becomes less than optimum times to buy it. And that's so important. And then there are times when the stock got undervalued and sometimes stayed undervalued for a long time. And interestingly, that happened a couple of times to CVS. Then it goes on, coming out of the recession of 08 and 09, as we see here, it gets overvalued in 2015 and stayed that way through most of 2016. And then this is where I started videoing about it again. And then we had this long extended period for most investors' minds, a heartbeat from a value investor's mind, but in most investors' mind, this is eternity. This is just really a wink of an eye as for a value investor. We saw the stock price drop, but fundamentals remained strong. Okay, so let's go back. Let's start with the beginning. Let's start with AmerisourceBergen. And, we produced these videos, and the first video I produced on AmerisourceBergen was produced, almost 5 years ago now. And it was titled Better Business Buyer, Check Out AmerisourceBergen. And this is what AmerisourceBergen looked like. Look at the old fast graph there. Isn't that cute? We've come a long way, baby, since then. But the bottom line is it was slightly above the orange line, but it was a reasonable valued stock. But it was really, the point of the video was it was such a great business. They had such consistent operating results. And then I did a follow-up video, and look how much Fast Graphs has changed since this, since that first video was done to this second video. And I did a follow-up video where AmerisourceBergen had really become really undervalued. And this is when I, did the second video. So if you go back to the chart here, I went into my transactions file, which you can do in Fast Graphs, and I marked where both of those videos were produced. Okay. And the first one was done on May 22nd, and I've got it marked here as close as I could, which is May 26th. So it's about 4 days later, but you get the point. And the stock was slightly overvalued, if you remember from the video. Once again, I go back in the video, you can see the price was slightly above the orange line. Okay. So that's when I basically first pointed out that this was a great business and how stock price had followed the earnings over that time. And when it got undervalued, how it corrected, it was now becoming fairly valued. Now, if I measure as a value investor, this was fair value. This is a decent time to buy the stock. It's not necessarily the best time ever, but a decent time. So if you're buying a stock at value, you get to participate in the full growth of the business. I've said that over and over again. So let's test that. I can use the calculator functionality of Fast Graphs. I can click on it here and then click on it to where it is today. And what I learned is that a $10,000 investment on that day, even though it dropped precipitously, over the next couple of years, was still grown to 18,000. Growth was over 80%. Annualized rate of return without the dividend was 11.7% from this point to that point. That's a very acceptable rate of return. Add in $959.89 of dividends, brings it up to almost a double, or a 12.8% annualized rate of return over this, 3 or 4 year time frame. The key is it's an annualized rate of return of 12.8%. So that was the first decision, which was a decent valuation for a value investor, but it didn't have that margin of safety I like to talk about. It wasn't a great value. The second purchase, however, was done in May of 2019. And if I go ahead and click on it here and calculate its performance to current, we see that the rate of return was almost double, 25.6% annualized. Here we more than doubled our money in about a 2-year less holding period, by the way. We ended up with a stronger rate of return, and we actually ended up with good dividend income, not quite as much, but $167 in dividend. This is again assuming a one-time $10,000 investment. Bottom line is we end up making 25.6%. So the stock from here to here earned 12%. The stock buying it when it had a margin of safety and was really cheap earned 25%. But I think the point that I want to make here is value investing works, and it works beautifully. It's because the business is ultimately what creates the value. The stock price is much more temporary than the functional performance of a great business. And I think that's a key message I want to point out here. But either one of these investments, although the first investment looked really bad for the first 18 months or 2 years, probably close to 2 years or so. Even if you go into past 2 years, it wasn't really making a lot of money. But here we are now, some 4 or 5 years later, and we've made a really excellent rate of return on either one of the times that we would have bought this stock. I'd take 12% all day if someone would give it to me. And of course, I love 25.6%. Okay, well, AmerisourceBergen, when I did that video, a lot of the viewers said, well, let's look at some of the other healthcare stocks. So I went ahead and produced similar videos on CVS. Now, CVS was a lot more problematic than AmerisourceBergen was. So let's put the transactions. Let's look at what the videos looked like at the time, though. The first video on CVS was January 18th, 2018. CVS had moved into fair value territory after being overvalued in much of 2015 and 16. And this is what the company looked like at that point. Then I did a second video on CBS, and you can see the newer version of Fast Graphs again, and yet the stock had deteriorated significantly more. I want you to note that. This was done on May of 2019, And then I did a third video where the stock had started to recover a little bit, but it was still significantly down from that first video. And this was on October of 2019. And then finally, most recent video I did was on November 1st, 2021, where the stock was beginning to recover. Okay, so if we go into CVS and once again use the transaction capability of fast graphs and go ahead and put those 4 dots, if you will, on the graph. So the first video I did was when it was slightly undervalued prior to the stock becoming a really what looked like a very poor performing stock for the next 3 or 4 years. They did not raise their dividend during this period of time. They simply maintained it at $2, but you got that $2 of income every year while you were waiting, and that was generating, if I look at the dividend yield here, we were looking at dividend yields over 3% back at this time. Okay, so we started out with a 3% dividend yield that was maintaining itself, and we got that every year while we were waiting for the good things to happen. But once again, if I measure the first time I bought the stock and measure it to where it is today, I ended up making 7.4%. I wouldn't call that stellar, even though the stock was attractively valued, although I don't think the, quote unquote, saying that the fat lady has sung, as they say in the opera, this company is still undervalued today, in my opinion, but certainly moving into, fair value territory. It's been doing that for the last 3 or 4 years. But this was a 7.5% rate of return. When the stock got really inexpensive on the second purchase that was made in May of 2019, and then held to yesterday's close, ended up generating a 23% annualized rate of return for that 3 or 4 year period. Again, producing, almost doubling in value and producing really strong dividend income while you were holding the stock, while you were waiting. And the performance, the key is that when you're looking at this, is the fundamentals continued to hold. They didn't necessarily have great years there. They had pretty good years, but the performance continued to hold. Look at the third transaction that was made in October of 2019. Hold that till today's value. And that one likewise ended up making almost 20% a year, 19.6. Threw off a lot of dividend income and turned 10,000 into 16,000 in just a couple of years. So it actually performed really well. And then the last time that I did CVS Health, I want you to notice that initially, in a matter of a few months from November of 2021 to October, it went up 99.5% in that short period of time. That's an annualized, 103% rate of return. But then it subsequently fell again before it's rising again now. But my rate of return for this time frame, which is still very short, too short to really judge, is averaging about 14%. And this is not how a value investor would judge their portfolio. This decision is too young to judge, even though it went through those machinations, that I just showed you. So the point is, value investing works, and it works beautifully for those who are patient and those that understand and recognize that stock price is obviously very erratic, and the stock price can get, the market can misappraise the value of your stock and price it horribly, at times. And it can do the same on the upside, by the way, where obviously if you would have paid this high premium for CVS back in, let's say, July of 2015 and held it today, you'd be making less than 1% a year. You'd actually have a slight loss in principal, and only the dividend bailed you out. But that has a lot to say about the importance of dividends. But the key is, if you buy a stock at reasonable values, you're going to end up all right. If you buy it at really attractive values, you can really make a great deal of money on the stock. And likewise, I want to make a point about AmerisourceBergen in that same regard here, because the price was all over the place and the price went down. But even from this first less than optimum time to recommend it, I want you to notice earnings growth the following years was 10%, 9%, 11%, 17%, 19%, and so on. So there are times when the earnings growth gets small. We even had that back in 2004 where it grew at 3%. But if you're buying a really good business, when you're buying it at attractive valuations and you hold it long enough, you're going to end up doing all right. So, value investing works, and it works beautifully. I think the key point is here that value investing reduces risk while simultaneously enhancing your rate of return. That's why I'm such an advocate of value investing, but it takes patience and it takes the ability to be able to state clearly in your own mind, and this is what's important, is how you are thinking about the stock, that, just because the stock price is down, Peter Lynch said this once very aptly, correctly. Just because you buy a stock and it goes down doesn't mean you're wrong. And just because you buy a stock and it goes up doesn't mean you were right. Ultimately, what really matters is whether the business is continuing to produce good earnings, good cash flows, good dividend growth, etc. Once again, I want to thank you for watching the video. I hope you enjoyed this video, looking back at some of the past videos I did and how they worked out over time. I think it's very important to revisit past decisions like that and see how they worked out. But if you enjoyed this video, give me a like, ring the bell, subscribe to the channel if you haven't already, and for goodness sake, subscribe to Fast Graphs. You can see all the beautiful things you can do with this tool and how it can help you manage your assets so beautifully. And by the way, we got some really exciting things coming up in January towards the end of the month. Hopefully we'll be launching international stocks by then. We might have some pretty interesting deals for you on that too. So you might want to start, taking a look at subscribing because, as I like to say, I couldn't even imagine investing without my subscription to Fast Graphs. Thanks for watching and hope you enjoyed this video, and we'll talk to you again real soon.